In this video, we're going to be talking about that moving average trading strategy and exactly how you can use it with your supply and demand trading. In fact, by the end of this video, you will be able to use this moving average trading strategy straight away. Hey supply and demand traders, I'm Jonathan, the founder of FX Trader, where in this channel I like to share with you my tips and tricks to becoming a better supply and demand trader. Now, as I said in the intro of this video, this is in fact the second part video going through the use of this moving average trading strategy. So if you missed the first part of the video, I'll leave a link above now so you can go through and watch that video first before you watch this video. So we're going to get straight into this video, going straight over to the charts. As you can see, we are on the EUR/USD daily time frame. This is in fact the moving average, the EMA we're going to be using, which we'll go through exactly which EMA it is and how you'll use it on your charts in a moment. First, we're going to go to a weekly time frame. I want you to see and understand how this EMA acts as an area of dynamic structure. You can see when it broke above with this bullish candle above this EMA, we came back, we tested it, we rallied away, we pulled back, we tested it once again. Even on the next candle, we tested it just about to the pip and we rallied away. It's at these areas you are going to find the highest probability trades on that next time frame. Now remember, when we're on a weekly time frame, we're going to that 4 hour. And that's where we're going to go through to look for an entry off this weekly time frame. When you're on the daily time frame, you'll be using the 1 hour. And if you use the 4 hour time frame, you'll be using that 15-minute entry. Now in this video, I'm also going to share with you how you can use an area of imbalance. And if you're not sure what that is, keep watching to the end on this video because you're going to understand exactly how you can use imbalances with this strategy to help you find high probability winning trades. So let me just remove this off the chart. So what we're going to focus on first is we're going to go through on this weekly time frame, this current area of price. We don't need to go back in time because you can just apply this straight away. I'm also going to show you how you can filter out trades with the use of time frames with this EMA. And then we'll go through exactly how you can use it and start trading with this EMA with supply and demand. Remember, you need a good understanding of supply and demand to use this strategy. So let's look at where we see the market coming back into this area right here. Even we have a test here once, twice, 3 times. Now when it's current price, you're going to have that EMA on the chart exactly where it needs to be. So we can see right now, if we was to look for 4 hour entry, we've got that much space for the market to pull back before we're looking for a trade. So when we're right here at the time, we know the market is going through that area on a 4 hour time frame. Now it's at this area we're going to understand where we're looking for a trade. So what we're going to do now, we're going to go back to this area in time. So go to a 4 hour time frame and we're going to scroll back and find this area. So let's just shrink the chart down so we can see the whole screen. Now it's this area here where we see the market. This is the beginning of that weekly candle. So this is actually where the market comes down during that week. And if you're not understanding the use of supply and demand, this is where you can find yourself trying to buy here, having a losing trade, trying to buy again, having a losing trade, and then eventually the market goes your way. So before you even get into any profitable trade, you're taking losing trades. So you need to understand how to find this trade at this area on the chart. Now this is where I'm going to tell you about an area of imbalance, how you would use that imbalance to find that area. When the market broke this area of market structure, we then rallied up with this big bullish candle. We broke this area of structure, so we went higher, and we broke this area of structure. Now we already know when we came back to test this area here, this was probably that area on that moving average at that time. The EMA was here. When it came down to here, we are going to be looking for the market. It's already removed this low in the market. We're coming into this low as well. Now what we want to see is the market removing some of those stops, giving you a false breakout at the same time as dropping into an area of demand. Now if you haven't seen that previous video on the strategy of the false breakout, you will understand what I mean by that false breakout. So I'll leave a link above now for you to go through and watch that video after this one. And what we're looking for is this big candle. Let me just highlight that candle. This big bullish candle right here is going to leave what we call an area of imbalance. Now what that is, I'm going to go closer into that candle now just to go through this first, because you need to really understand what I'm talking about. So the area of imbalance is left behind when we see this big bullish candle to the upside. Look at how we had all the buys in this candle all the way up. We removed this area of structure in the market. Then the market basically from the high of that last bearish candle to the low of this bullish candle, we left all this area open where there was absolutely no selling in the market. And this is key to understand. This is left an area of imbalance. And what you'll find is that the market will come back to fill it. Now you can see on the very next candle, on this bearish pin bar, we came back and we rallied away. So it's already come back to area imbalance. But that's now left us a new area of imbalance. From the low of that candle, we can see the market eventually came back once again and we rallied away. So once again, it's come back to imbalance, but at this point, it hasn't yet come back to our entry area based on this moving average strategy. So now we'd mark off from this low to this low and we'd spread it out. We can see once again, we came back, we did a false breakout into that area of imbalance, what's left over, and we rallied away once again. So once again, the imbalance has come back to be filled. Remove this area. So now you can see that we now bring it down to this candle and we still have this area of imbalance left. Now if I was to remove this area, we know we're looking for a trade. We're going to project this into the future. Let me just see on the right. Yeah, so we're going to go to, let's go to the 8th. So we bring that into the future. As the market comes back in, you can see we come back into that imbalance once again, where you could have had an entry at that level, the low, and you can see the market is rallied away. That is how you'll actually use an imbalance when you're looking to take a trade. If you have an imbalance like this on the chart, that is how it's going to work. Now, most people will look at this perhaps as what? A previous area of market resistance, broken, became support, became support. Now that isn't exactly what is happening. The retail traders are looking at that as a broken area of resistance becoming support. What you now understand is that it's left this area imbalance which had to be filled to pick up those orders. At the same time, it's going to remove previous stops in the market. More to come on that in future videos. And as I said in the previous video, there's a new course coming out called Forex Domination, which will be packaged to teach you all of these concepts to help you to become a profitable trader. Now, as the market goes up, we pull back. I can now actually go to this low. Now, if we quickly pop back to the weekly time frame, you'll be able to see here that the market pulled back once again on this bearish pin bar, came back to that area on the EMA. So what we're looking for now, we're going to go back to that 4-hour time frame. And as you see, the market comes back. This is where it's coming back to, at that area of the EMA. What do we have at this occasion? We have this area of demand. And that's where you can use your supply and demand technique, understanding we had a break of previous market structure here and here. We've pulled back. You can use your Fibonacci's, whatever you like. We came back to zero demand at that area on the EMA on the weekly time frame. That is what I'm trying to say about using multiple time frames. This then gives you a much better risk to reward, and you can see the market goes up. But what I'm going to show you now is how you can fine tune this entry to even find a better entry on a 15-minute. Remember what I said in that previous video, you can actually go from a weekly down to a 4-hour, down to a 15-minute entry if you wish. Now when we see the market bouncing off this area of demand, We rally up, we pull back to where? Our moving average. And again, we're going to apply the same technique just as we did on that higher time frame to the 4 hour. Looking for the market to come back. So we'll mark off that area. Okay, now we're going to go down to a 15-minute. And now on the 15-minute, we're going to find that area now. Let's go back, here we are. So this is our area on the chart. And you guessed it, we're going to understand the use of supply and demand once again. I'm also going to show you how you can even apply this with a 1 hour time frame with an area imbalance in a moment. So I'll show you how you can use a daily and a 1 hour for an entry with the use of an imbalance. But I want to go through now with the use of area of demand, understanding how you can apply this technique. So what we're looking for is a break of this previous area of market structure. The market pulls back. That line is what we have as our EMA on the 4 hour time frame. We bounce off it, we pull back, we rally up, and we break this area of market structure. What does that leave? That leaves me this area of demand right here, where we then see the market pulling back into for an optimal entry with a very small stop, and up the market goes. Now I don't need to show you what the risk to reward is there, because even from this area, we can see that this is all your reward and this is your risk. Now, if I go forward, that even goes higher up to here. So that is how you can apply the technique of understanding that. Let me just come off this. We'll go back. I'm going to draw this zone out. This is that zone of demand where the market came back. And if we place our fib tool on, so this is my entry, my stop. You can see the market actually goes up to over 11 to 1 risk to reward, and even higher up to head to nearly a 13 to 1. So that is how you can use the weekly time frame down to a 4 hour, then a 4 hour down to a 15-minute entry. Understanding how supply and demand works is the key to this. So again, if you haven't been through those previous videos, especially starting with that first video, I'll leave that link above now for you to go through and watch that first video at the end of this video and go through all the videos on my site, because every single video has been created in mind to help you becoming a better trader. And again, if you're enjoying this content so far, don't forget to give me that thumbs up, as it helps me to know that you're enjoying this content and for me to go forward creating more content just like this to help you with your trading. And of course, if you have enjoyed this video, don't forget to leave a comment below to let me know you've enjoyed it even. And if you have any queries on what I'm showing you today, leave that comment to let me know what you need help more with and what you'd like to see from me in this channel in the future. So that is a 4 hour entry with a 4 hour setup with a 15-minute entry. Now I'm going to go to a daily time frame. We remove everything off the chart quickly. And we go to current price again, because I want to show you current price. Nobody ever shows you the closest point where you can use these types of strategies. It always shows you previous areas. I could have gone through all this area here, you see on the chart. All the way up there was perfect entries using this strategy. I want to show you current price. I'm also going to show you when we wouldn't be taking this trade. Let me just highlight this section. When we break through on this candle to downside, you wouldn't be taking a trade here, because if you go up to the next time frame, so as you can see, we are above that moving average still on the weekly time frame. And that is why when we go to that daily time frame, we wouldn't be looking to sell here, because we are still up on that weekly time frame. That's understanding the multiple time frame analysis. And again, I'll leave that link above now for that video on multiple time frames, so you can understand the idea of using multiple time frames with your trading. Now that is how you're going to look at using the weekly, the 4 hour, and the 4 hour with the 15. We're now going to go through the daily and the 1 hour, but before we do that, I'm going to walk through now exactly what EMA we're using and how you apply it and use it now in your trading. So we are using the 8 EMA applied to close. That's all you need. I've applied this. Let me show you. I've applied it to a monthly, weekly, daily, 4 hour. You don't really need it on a 1 hour time frame. You can if you want to go down to a 5-minute entry, but let's just leave it on a 4 hour. So you can see the market respects, after we break back above, we don't really respect it here. There was an entry, I'll show you in a minute, you could have taken one, But when we break up, this is more important. You want to see it respecting and holding as an area of dynamic structure in the market. It's important it holds at the 8 EMA. Now, as I said, this is not your typical type of strategy with the use of EMA. You normally will see a crossover strategy, a EMA for the trend, or even 2 EMAs to act as an area of dynamic area of support resistance. So this is understanding an EMA to use with an area of market structure. So when we see this area, we're now going to go down to a 1 hour time frame and just go through exactly how you will apply this, and then you'll understand how you can start using this. So once you see the market pulling back to this area, all this area on the chart, we're then going to go down to 1 hour. And remember, at this point in time, you know you're coming into that area already, because you know that's where it sits. So this is the first point. We see the bounce off. We pull back into it once again. Now it's here you're most probably going to be looking for your trade, all this first area. Now, what I'm going to show you once again is understanding that area of imbalance in the market. So we go close into price. This is our area of structure that has to be broken. The candle actually started the move up was from here. We moved up and we went sideways and we broke higher. Now there is an area of imbalance. We just show you sitting here. And there is an area of imbalance which sits here. Now if we go back into price further on, you'll see that this area of imbalance was removed on this push down. So that's been removed. We then left this area and look where price came into. And let's remove this line. You can see that price, using this area of imbalance, is exactly where the market came into. And if I may just extend this again, and we go forward, you'll see exactly on this entry we were looking for a trade. As it came back, it came straight into that area of imbalance. So that is how you can look for an entry. You can look for that area of imbalance for your entry, or you could even use this area of demand. Now on the first one it tested it, on the second it didn't. But remember, when the market came back into this area of imbalance, you could have looked for an entry off here with obviously a stop below the low here, or you would look what we went through on that 4 hour time frame going down to a 15 minute. You apply the same strategy on a 1 hour going down to a 5 minute. Now there was an entry here based on this big spike to downside off this area of demand as well. So you could even call an entry off this area of demand on a lower time frame, or this 1 hour even as well. So that is how you can apply all of this into a supply and demand trading strategy with a moving average trading strategy in Forex trading. So I hope this video has been insightful. I hope you enjoyed the content. Don't forget to leave me a comment if you have, and to give me that thumbs up so I know you're enjoying this content. And I will catch you all in the next video, which you'll find coming up next right now.